Good morning, welcome to our earnings season special. Just a quick recap on some of the big earnings releases that we've had overnight. Apple being the main one, of course, also Facebook, but we just dive into Apple earnings. They posted a record fourth quarter, it's their fiscal fourth quarter in the 3 months to the end of September. Revenues up to $64 billion, up 2%, and earnings per share beating expectations at $3.03, ahead of the expected $2.84. All that despite a 9% decline in iPhone sales. That's not as bad as it has been. We've seen iPhone sales dropping 15% in previous quarters. Once that switch happened, and we saw iPhone sales start to decline. So some stabilization there. Also, of course, key guidance for the fiscal first quarter 2020, i.e. the key holiday quarter over Thanksgiving and Christmas in the US, that is robust, and I think there's a sense that they'll see versus a year-on-year comparison against the iPhone sales in China will be particularly encouraging, because it was that first quarter that we saw of the 2019 year that we saw a big drop off in Greater China iPhone sales. They really struggled there. So I think we'll see with the iPhone 11, it's $50 cheaper than before. They've reduced the price on that, so it's looking a bit more encouraging. I think the consumer response to the iPhone 11 has been better than analysts had thought. Also, whilst we're talking about iPhone sales, the fact is that they're also growing their revenues and earnings from other divisions, and that's key. So services growth up 18%, very encouraging. That was same as last quarter, which if you strip out the one-off items that took it down to 13%, was also 18%. So services growth really strong, now accounting for about 20% of revenues. Wearables also performing very well, up 54% to $6.5 billion. So those two divisions doing really well. That's very encouraging. Higher margin helps re-rate the stock a bit higher, and so the stock's trading now on 20 times earnings versus 15 times earnings as an average over the last 5 years. I think these are encouraging numbers for Apple. We saw shares up $5 aftermarket. So they closed at 243 and change, up at 248 and change aftermarket, eyeing an all-time high at $250. We've had analysts reiterating their stances. Sell from Rosenblatt, quite why, I'm not quite sure. Otherwise, maintaining buy and hold positions there on Apple. I think there's also been a price target upgrade, but we're not quite sure on that one just yet. So Apple's looking very strong. Facebook also strong, beating top and bottom line. Ad revenues up 29%. Monthly active users up 8%. Again, that was the same as last quarter. Just consistently strong. The overhang from the ditch Facebook campaign and stuff seems to have passed out. I think advertisers simply cannot ignore what Facebook is to the consumer. Just a quick one on some UK stocks. We've had a fair batch of FTSE 100 companies reporting. Shell dragging the index down after its income missed expectations, down 15% on last year. Also concerns about a share buyback program that won't get it completed in the time it had thought. So Shell accounts for 10% of the FTSE, and it's dragging that down. I think basically just looking at lower oil prices and weakening global demand for oil has been the key reason for Shell. It's actually been doing a pretty good job of cutting costs and so on, but it probably can't cut costs much more than it already has. Lloyd's shares were down. Its profits wiped out by PPI claims. It's had to set aside $1.8 billion for new PPI claims. Now that was at the top end of the range that it guided in September. It said 1.2 to 1.8 billion would be needed, and it turns out it's 1.8. Profits down at £50 million as a result. Net interest income also down 3%, and return on tangible equity slipping to 6.8% now for the 9 months year to date, compared with 13% a year ago. So that profitability number looking a bit shaky. Total costs, so it's cutting costs well. Total costs down 5%, and its cost to income ratio remains very strong at 46.5%. The other one, BT, doing a bit better, matching expectations, sticking to its dividend. As I said in the note this morning, it may need to cut that sooner than it wants to in order to free up cash to spend on 5G and fibre rollout. The company has reported net debt ballooning to over £18 billion from £11 billion last year. So that net debt is a concern for BT and puts that dividend under pressure, we believe. IG also suffering from the pilot strike, took a knock of €155 million off the back of that, and it's sticking to its September profits warning. Also Air France KLM reporting softer demand hitting numbers today, so airlines under a bit of pressure as a result. So lots of earnings that have been reported so far. We've got more coming out this afternoon from the US side, and we'll bring you an update on what those are and mean later in Walk on Wall Street, and then also tomorrow in our final earnings season special of the season. Otherwise, that's it for now. Thanks for watching.